Disclosure. The information provided in this video is for educational and informational purposes only. It should not be considered financial or investment advice. I am not a licensed financial advisor, and the content in this video is based on my personal opinions and research. Investing in the stock market carries risks, and it's important to conduct your own research and consult with a qualified financial advisor before making any investment decisions. Past performance does not guarantee future results, and all investments carry the risk of loss. In the intricate world of finance, short selling stands out as a strategy shrouded in intrigue. Unlike traditional investing, where the goal is to buy low and sell high, shorting involves profiting from the decline of a stock's price. It's a bold bet against the market, demanding a deep understanding of market dynamics. While the potential for profit is significant, the potential for losses is theoretically unlimited. Proceed with caution. To grasp short selling, understand the step-by-step process. First, borrow shares of the stock you believe will decline in value. These shares are borrowed from a brokerage firm. The short seller sells them on the open market. Proceeds are held as collateral. The short seller owes the brokerage the same number of shares. The hope is the stock price will decline. If it does, they buy back shares at a lower price and profit. If the price rises, they buy back at a higher price, resulting in a loss. In short selling, the broker plays a pivotal role, acting as a facilitator and guardian of the shares. They search for shares to borrow, lend them to the short seller, and sell those shares in the market. Proceeds are held as collateral. Brokers charge a borrow fee, an interest rate on the borrowed shares. If the stock price rises, a margin call may be issued. Failure to meet it could lead to closing the short position. Short selling offers a chance to profit from declining stock prices, but it's not for the faint of heart. The risks are inherently higher than traditional investing. One major risk is the potential for unlimited losses. When you buy a stock, your maximum loss is limited. But with shorting, there's no limit to how high the price can rise. If the stock triples, your losses triple too. Beware of the short squeeze. A sudden price surge can force short sellers to buy back shares, fueling the rise. This creates a cycle of buying pressure and potential astronomical losses. The allure of short selling lies in its potential to generate profits when stock prices decline. By borrowing shares at a higher price and buying them back later at a lower price, short sellers aim to capitalize on negative market sentiment. However, the path to profitability in short selling is fraught with challenges, requiring a delicate balance between potential gains, inherent risks, and interest payments. When a short seller accurately predicts a stock's decline, the potential for profit is directly proportional to the magnitude of the price drop. Let's dive into a hypothetical example to illustrate how short selling plays out in practice. Imagine an investor named Sarah, who closely follows the tech industry. She believes Innovate Tech's latest smartphone release has been met with lukewarm reception. Sarah suspects the company's stock, currently trading at $100 per share, is overvalued. She decides to short 100 shares of Innovate Tech. She contacts her broker and initiates a short sale order. The shares are sold at $100 per share, generating $10,000 held as collateral. Sarah's short position is now open. Her profit depends on buying back the shares at a lower price, minus fees. If Innovate Tech's stock price rises, she will incur a loss. Sarah closely monitors Innovate Tech's stock performance. Her research and intuition appear to be on point. Negative reviews of the company's latest smartphone model surface. Competitors ramp up their marketing efforts and unveil innovative products. The negative news takes its toll on Innovate Tech's stock price. The stock drops from $100 to $80 per share. Sarah decides to cover her short position. She instructs her broker to buy back 100 shares at $80 per share. The total cost is $8,000. Sarah returns the shares to the broker, closing her short position. Her profit is $2,000, minus borrow fees. This example shows how short selling can be profitable. But remember, short selling carries risks. If the stock price had risen, Sarah would have incurred a loss. Short selling offers the allure of profiting from declining stock prices, but comes with the risk of unlimited losses. There's no limit to how high a stock's price can rise. Unlike buying a stock, short selling exposes you to boundless downside. Imagine shorting a stock at $50 per share. Unforeseen events could send the stock soaring. As the price climbs, your potential losses multiply. This underscores the importance of meticulous research and prudent risk management. Short selling is conducted on margin, borrowing money from your broker. Margin amplifies profits and losses, introducing margin calls. If the stock price rises, your broker may issue a margin call. Failure to meet a margin call could result in forced liquidation. Monitor positions closely and avoid over-leveraging. In the world of short selling, the term short squeeze strikes fear into the hearts of even the most seasoned investors. A short squeeze occurs when a heavily shorted stock experiences a rapid and significant surge in price, often driven by positive news, strong earnings, or sudden buying pressure. As the price climbs, short sellers rush to buy back shares to cover their positions and limit their losses. This frenzied buying activity creates a feedback loop, further propelling the stock price upwards. The short squeeze continues until short sellers have covered their positions or until the buying pressure subsides. In some cases, a short squeeze can lead to a stock's price skyrocketing far beyond its fundamental value, creating a bubble that eventually bursts. This phenomenon can turn a seemingly profitable short position into a catastrophic loss within a short period. While the potential for unlimited losses and short squeezes often dominate discussions about short selling risks, other factors can also impact your short positions. Two such factors are interest rates on borrowed shares and corporate actions. Short selling involves borrowing shares from your broker, and this borrowing privilege comes at a cost: the borrow fee. This fee, typically calculated as an annual percentage rate, is deducted from your account for as long as you hold the short position. The borrow fee can vary widely depending on factors such as the specific stock, its availability, and the demand for shorting it. Stocks that are heavily shorted or considered hard to borrow often command higher borrow fees. Corporate actions such as dividend payments, stock splits, and mergers and acquisitions can also impact your short positions. For example, if you're short a stock that pays a dividend, you'll be responsible for covering that dividend payment to the lender of the shares. Similarly, a stock split can affect the number of shares you're short, potentially increasing your exposure and risk. To mitigate these impacts, it's essential to stay informed about the companies you're shorting and monitor your account statements closely. While the risks associated with short selling are undeniable, the potential rewards are equally compelling. Unlike traditional investing, where profits hinge on a stock's price appreciation, short selling allows investors to profit when a stock's price depreciates. If an investor believes that a particular stock or the overall market is overvalued and poised for a correction, short selling provides a mechanism to profit from that anticipated decline. This ability to profit from both rising and falling markets is a key advantage of short selling. The potential profits from short selling are theoretically unlimited, mirroring the unlimited risk associated with this strategy. As a stock's price falls, the short seller's potential profit increases proportionally. This asymmetry between potential gains and losses is a double-edged sword. For investors with a deep understanding of market dynamics and a disciplined approach to risk management, short selling can be a powerful tool. It offers the potential for substantial returns, particularly during market downturns or when specific companies face challenges. Beyond its potential to generate profits from declining stock prices, short selling can also serve as a valuable risk management tool. This hedging capability stems from the inverse relationship between short selling and traditional investing. Instead of selling off portions of their portfolio, the investor could use short selling to hedge their exposure. If the tech sector declines as anticipated, the profits from the short position would help offset losses in their long tech holdings. This ability to hedge against market downturns and sector-specific risks is a key advantage of short selling. The leverage advantage amplifying returns and risks. Leverage allows investors to control a larger position with a smaller amount of capital, magnifying both potential profits and losses. When short selling on margin, investors borrow money from their broker to finance a portion of the trade. If the stock price moves in the investor's favor, leverage amplifies those gains. However, if the stock price moves against the investor, leverage also magnifies the losses. Leverage is a double-edged sword, enhancing returns and increasing risk. Contrasting objectives: decline versus growth. In the realm of investing, understanding the fundamental differences between shorting and short-term investment is crucial. While both strategies involve buying and selling assets within a relatively short time frame, their underlying objectives and risk profiles are distinct. Shorting is inherently a bearish strategy, driven by the anticipation of a decline in an asset's price. Short sellers aim to profit from this decline by borrowing shares, selling them at the current market price, and then repurchasing them later at a lower price. This strategy thrives in bearish market conditions or when specific companies face challenges. Short-term investment, on the other hand, is a bullish strategy, fueled by the expectation of an asset's price appreciation within a relatively short time horizon. Short-term investors seek to capitalize on market trends, company-specific catalysts, or technical indicators that suggest an asset's price is poised to rise. This fundamental difference in objectives shapes the entire approach to these two strategies. Short sellers meticulously search for overvalued assets, scrutinizing financial statements, industry trends, and competitive landscapes. Short-term investors focus on identifying undervalued assets or assets with strong growth prospects. Risk and reward, a tale of two strategies. The contrasting objectives of shorting and short-term investment are linked to their respective risk and reward profiles. Shorting, with its potential for unlimited losses, is inherently a higher risk strategy. The allure of shorting lies in its ability to generate significant profits in a declining market. However, this potential for outsized returns comes at the cost of unlimited risk. If a stock price rises instead of falling, the short seller's losses can escalate rapidly. Short-term investment, while not without risks, offers a more moderate risk profile compared to shorting. The maximum loss for a short-term investor is limited to their initial investment. If a stock price falls to zero, the investor loses their entire investment but no more. This limited downside risk makes short-term investment a more appealing strategy for investors with a lower risk tolerance. However, the lower risk of short-term investment comes at the expense of potentially lower returns compared to shorting. While short-term investors can achieve significant profits, their potential gains are capped by the magnitude of the asset's price appreciation. In contrast, short sellers can realize profits that far exceed the initial investment, particularly in a rapidly declining market. In the high-stakes game of short selling, the term short squeeze evokes a sense of dread and fascination. It's a phenomenon that can transform a seemingly calculated short position into a financial maelstrom. At its core, a short squeeze is a rapid and often unexpected surge in the price of a stock, typically one that has been heavily shorted. This surge is fueled by positive news flow, strong earnings reports, or a sudden influx of buying pressure. As the stock price climbs, short sellers find themselves in an increasingly precarious position. Their losses mount with each tick of the price upward, and the pressure to cover their positions intensifies. This scramble to cover creates a self-fulfilling prophecy as the increased demand for shares further fuels the price surge. As more short sellers rush to buy back shares, the upward pressure on the stock intensifies, creating a vicious cycle. The GameStop short squeeze of early 2021 stands as a stark example of how quickly and dramatically a short squeeze can unfold. It's a tale that captivated Wall Street and highlighted the growing influence of retail investors. GameStop, a once struggling video game retailer, became an unlikely symbol of defiance against Wall Street hedge funds. A confluence of factors, including a strategic turnaround plan and a surge in retail investor interest, ignited a buying frenzy. As the stock price climbed, short sellers found themselves trapped in a tightening vice. Their losses mounted exponentially, and the pressure to cover their positions became unbearable. The ensuing scramble to buy back shares only intensified the upward spiral. GameStop's stock price soared from around $17 per share in early January 2021 to over $480 per share in late January. The GameStop short squeeze sent shockwaves through Wall Street, inflicting billions of dollars in losses on hedge funds. It also highlighted the growing power of retail investors and the unpredictable forces of speculation and herd behavior. Short selling is a bold and potentially lucrative strategy for profiting from a stock's decline. It involves borrowing shares from a broker, selling them at the current market price, and then repurchasing them later at a lower price. While this direct approach offers the potential for substantial gains, it also exposes investors to unlimited risk. When you short a stock, your potential losses are theoretically limitless because there's no ceiling to how high a stock's price can rise. If your short thesis proves incorrect and the stock price climbs, you'll be forced to buy back the shares at a higher price, incurring a loss. Moreover, short selling involves ongoing costs, primarily in the form of borrow fees or interest charged by the broker. These fees can accumulate over time, especially if a stock becomes hard to borrow. The longer you hold a short position, the more these fees will eat into your potential profits or exacerbate your losses. Despite these risks, short selling remains an attractive strategy for investors seeking to capitalize on market downturns. It offers the potential for significant returns in a bearish market. However, it's crucial to approach short selling with caution, conducting thorough research and implementing risk management strategies. Buying put options offers a way to profit from a stock's decline while limiting potential losses. A put option grants the holder the right to sell shares at a predetermined price before a specific date. If the stock price falls, the value of your put option increases. Unlike short selling, the maximum loss is limited to the premium paid. Options trading involves its own risks and complexities. Shorting versus puts, a matter of strategy. The decision to short a stock or buy put options depends on risk tolerance, investment goals, and market outlook. Both strategies have distinct advantages and disadvantages. Short selling is high risk, high reward, suitable for experienced investors. Put options offer a less risky alternative with defined risk. The choice depends on the anticipated decline's magnitude and timing. Align your strategy with your risk tolerance and goals. In short selling, a critical tool for risk management is the stop-loss order. It limits losses by triggering an automatic buyback if the stock's price moves against the investor. This is vital for short sellers due to the potential for unlimited losses. For example, shorting a stock at $50, you might set a stop-loss at $60. If the stock rises to $60, the stop-loss triggers, capping your loss. This approach helps cut losses and avoid emotional decisions during market volatility. Limit orders manage potential profits and reduce losses. They set a specific price to buy back shares for short positions. Unlike market orders, limit orders execute only at your specified price. Place a limit order to buy back shares at a lower price to lock in profits. Diligent market monitoring is crucial for short sellers. Stay informed about news and earnings reports to respond swiftly. Use limit orders and monitor the market to manage trades effectively. Diversification is a fundamental principle of risk management that applies equally to short selling as it does to traditional investing. By spreading your short positions across multiple stocks or sectors, you can reduce the impact of a single adverse event. Diversification helps mitigate the risk associated with individual stocks. Another critical aspect is avoiding margin over leverage. While margin can amplify returns, it also magnifies potential losses. Over-leveraging increases the likelihood of margin calls, forcing you to close positions at unfavorable prices. Setting realistic position sizes and adhering to strict risk management rules can help you stay within safe leverage limits. Short selling, as a strategy, holds a unique place in the world of investing. It offers the potential for substantial profits in declining markets. However, the complexities and inherent dangers of short selling cannot be overlooked. Shorting a stock involves borrowing shares, selling them, and buying them back at a lower price. The profit is the difference between the selling and buying prices. This strategy demands rigorous research and a strong grasp of risk management techniques. The potential for unlimited losses is the most daunting risk. Yet, the benefits, like profiting in a declining market, can be significant. Short selling is an attractive option for sophisticated investors who can navigate its challenges. Investors should weigh the potential rewards against the substantial risks. By doing so, they can make informed decisions and potentially enhance their investment portfolios. Thank you for joining us on this exploration of short selling. Don't forget to like, share, and subscribe for more insights into stock market strategies.